Ever wondered where all the money in the economy actually is? Like, we hear about trillions of dollars, but it's not all just sitting in giant Scrooge McDuck vaults, right? A big chunk of it is actually circulating, constantly being used for transactions, and that's where something called M1 comes into play. It's a fundamental concept in economics, a snapshot of the most liquid forms of money sloshing around, ready to be spent. But what exactly is an M1 loan? And how does this seemingly simple definition have such a profound impact on everything from interest rates to inflation? That's what we're diving deep into today. Before we unravel the intricacies of M1 loans, it's crucial to understand what M1 itself represents. Think of it as the most readily accessible form of money in an economy. It's the cash in your wallet, the funds in your checking account that you can access with a debit card or write a check against, and even traveler's checks, though those are becoming increasingly rare. The key here is liquidity, how easily and quickly an asset can be converted into cash for immediate use. M1 represents the highest degree of liquidity. Now, you might be thinking, okay, so M1 is just cash and checking accounts. Where do loans come into this? This is where the concept gets a little more nuanced. An M1 loan isn't a specific type of loan product you'd apply for at a bank, like a mortgage or a car loan. Instead, it's a way of understanding how the creation of loans impacts the M1 money supply. When banks issue loans, they aren't simply lending out existing deposits. Instead, they are essentially creating new money in the form of credit in the borrower's account. This newly created money becomes part of the M1 money supply, increasing the total amount of readily available funds in the economy. Let's break this down with a simplified example. Imagine a bank has $100 in deposits. According to fractional reserve banking, which is how most modern banking systems operate, the bank is required to keep a certain percentage of these deposits in reserve, let's say 10%. This means they have $90 available to lend out. Now, when the bank issues a $90 loan to someone, that $90 isn't just transferred from someone else's account. Instead, the bank credits the borrower's account with $90. This $90 is newly created money that the borrower can now spend. This new $90 in the borrower's checking account is now part of the M1 money supply. So, the act of lending, particularly by commercial banks, is a primary driver of the expansion of M1. Every time a new loan is issued and the funds are credited to a borrower's transactional account, the M1 money supply increases. Conversely, when a loan is repaid, the money effectively disappears from the M1 supply. Now, why is this important? Understanding how M1 is affected by lending has significant implications for the overall economy. A larger M1 money supply can lead to increased spending and economic activity, as there's more readily available money chasing goods and services. However, if the M1 money supply grows too rapidly without a corresponding increase in the production of goods and services, it can lead to inflation, a general increase in prices, and a decrease in the purchasing power of money. Central banks, like the Federal Reserve in the United States or the Bank of England in the UK, closely monitor the M1 money supply and use various tools to influence lending activity and, consequently, the growth of M1. One of the primary tools is the reserve requirement, the fraction of deposits that banks are legally required to hold in reserve. By increasing the reserve requirement, central banks reduce the amount of money banks have available to lend, thus slowing down the growth of M1. Conversely, lowering the reserve requirement allows banks to lend more, potentially increasing the M1 supply. Another crucial tool is the policy interest rate, often called the federal funds rate in the US or the bank rate in the UK. This is the target rate that commercial banks charge each other for the overnight lending of reserves. By raising the policy rate, the central bank makes it more expensive for banks to borrow money, which in turn can lead to higher interest rates on loans for businesses and consumers. This increased cost of borrowing can dampen loan demand, slowing down the creation of new M1. Conversely, lowering the policy rate makes borrowing cheaper, potentially encouraging lending and increasing the M1 supply. Open market operations are another key instrument. This involves the central bank buying or selling government securities in the open market. When the central bank buys government securities, it injects money into the banking system, increasing two banks' reserves and their ability to lend, thus potentially increasing M1. When the central bank sells government securities, it drains reserves from the banking system, reducing lending capacity and potentially slowing M1 growth. 1. Fastercapital.com. Fastercapital.com. 2. Brainly.com. Brainly.com. It's important to note that M1 is just one measure of the money supply. Economists also track broader measures like M2 and M3. M2 includes M1 plus less liquid assets like savings accounts, money market accounts, and small denomination time deposits. M3 includes M2 plus even less liquid assets like large denomination time deposits and institutional money market funds. While M1 focuses on the most liquid forms of money directly used for transactions, M2 and M3 provide a broader picture of the money supply and can offer insights into potential future economic activity. The relationship between M1 loans and the sense of lending impacting M1 and the economy is complex and constantly evolving. During periods of economic expansion, loan demand typically increases, leading to a faster growth in M1. This can fuel further economic activity but also carries the risk of inflation if not managed carefully. During economic downturns, loan demand tends to decrease, slowing down M1 growth and potentially exacerbating the recessionary pressures. Furthermore, technological advancements and the rise of non-bank financial institutions have added layers of complexity to the traditional understanding of M1. The increasing use of digital payment systems and the growth of fintech companies mean that transactions can occur more rapidly and through channels that may not be fully captured by the traditional M1 definition. This has led to ongoing discussions among economists about the most accurate and relevant measures of the money supply in the modern economy. So, to recap, an M1 loan isn't a specific loan product. Instead, it refers to the process by which the act of banks issuing loans increases the M1 money supply. This happens because banks create new money in the form of credit when they make loans, which becomes part of the most liquid form of money circulating in the economy. The growth of M1, driven largely by lending, has significant implications for economic activity and inflation, and central banks actively manage lending through various tools to maintain price stability and promote sustainable economic growth. Understanding this fundamental relationship between lending and the M1 money supply is crucial for grasping the broader dynamics of how money and credit influence our everyday economic lives. With that said, thanks for watching and until next time.